Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Thomas DiFazio. Thomas is a director on the research team at Strategas, and we are going to talk all things equity markets and asset allocation today. But first, Thomas, how are you doing?
I'm great, Ross. Hope you're doing well. Thanks for having me.
Yeah, doing really well. Thrilled to have you here, and as we mentioned, ahead of a longer weekend, so something to look forward to. But first, I want to discuss your all's asset allocation effort. It's kind of the way I think about it is the culmination of all of the research that you all do spills out in how you position your portfolios for the current environment. So I was wondering if you could talk through any of the big changes you've made over the last few months that you think are important, or any of the changes that you haven't made, because those could be equally important as well.
Yeah, absolutely. It'd be my pleasure. If I were to summarize what our current thinking is as a whole, it would just be with two words: cyclically cautious. As a whole, we remain unchanged on both an equity, fixed income, and cash and alternative standpoint for the month of August. And I'll start with the equity side. We remained unchanged from that standpoint for two reasons. First one being there's a continued imbalance within the labor market between openings as well as workers supplied. So we have the supply and demand imbalance there. And then number two, we still are seeing elevated levels of core CPI. Now that doesn't mean there hasn't been improvement, but there are still elevated levels here, and we think that in order for the Fed to ease up a little bit, core CPI is going to need to come in more. And there's a little bit of a worry in the back of their minds that CPI does tend to move in waves, and that is something that my colleagues on the economics team have been discussing quite frequently, and because it's an important topic. So we believe the Fed is going to remain vigilant and is going to remain a little bit higher and let the data come to them. So that's why we remain unchanged on the equity side of things. For fixed income, we also remain unchanged, but we are mindful of the fact that interest rates have hit cycle highs, and we are starting to get a little bit interested in, if the 10-year keeps rising at the rate it has been, that we might want to start to consider adding an allocation to fixed income in order to get some capital appreciation on the longer end of the curve. Now, this is still a work in progress, but where this is something that we're considering on the fixed income front. And then as a whole, the overall size of, the overall level of rates is going to continue to be a factor on equity market multiples as a whole. Just to remind you of what we talked about a couple months ago at this point, we continue to use a three bullet point framework to inform our asset allocation. First one being normalized levels of CPI. We just talked about that. That's a work in progress, but we still think that there's room to go there. Two, level setting valuations for the overall market. We think they're a little bit out of sync right now with the interest rate environment and the inflation environment. And then number three, organic drivers of growth that can translate to a more durable economic recovery. We talked recently about how AI could be a source of that, but as a firm, we remain a little bit skeptical that it is going to be mature enough to be able to provide that drive to get the economy onto that next move higher. So we continue to watch on that front, but we remain skeptical.
I think that makes plenty of sense. Market's still pushing back up right near cycle highs. So caution makes some sense. And I'm curious, you all also do a lot of work in the factor space, and maybe you could explain that a bit, but also what are you seeing from other investors as maybe a complement or pushing up against what you all are talking about for your asset allocation portfolios?
Yeah, absolutely. Somewhat paradoxically, actually, we've noticed on the technical strategy side of things, the classically defensive sectors have really provided no relative protections, and they're actually hitting new relative lows versus the overall market. So in a way, investors are not getting classically defensive. They're not looking at staples and utilities as their sources of protection. But when you start to dig into the factor performance profile, there is some conservative positioning going on underneath the surface within the various sectors. And really what I'd like to emphasize is that investors are avoiding your high beta and your high short interest stocks within most sectors. And instead, they're allocating towards your large and mega cap stocks, think like Apple and Microsoft. And then they're allocating as well to high margin companies, high free cash flow growth companies, as well as high ROE and high return on invested capital companies. So as a whole, investors are skewing up the high quality scale, and they're not getting too inclined to add risk to the portfolios at this time. So as a whole, maybe they're not appearing too defensive, but investors are positioning and adding quality to their portfolio from a year-to-date perspective.
And I think at this point in the cycle and where we see valuations, that makes all the sense in the world. So even if it's not showing up in utilities or staples, which are a bit yield sensitive, good to dig a layer deeper. And I appreciate that insight from you all on how folks are positioned. So Thomas, this has been super insightful. I want to thank you so much for the time as always, and hopefully we'll get to talk again soon.
Yeah, my pleasure, Ross. Thanks for having me, and have a great Labor Day weekend.
You as well.